The Nuburu Inc. stock, BURU, is currently trading at $0.3765, reflecting an impressive intraday move of up $0.09 or 31.08%. Now, that's the headline number, and it tells a compelling story of sudden, massive momentum. But here's the unexpected angle right out of the gate. This isn't a story about a blue laser company getting a huge industrial order. That immediate 31% surge isn't fueled by a sudden, massive uptick in high-speed welding demand. Instead, the real propellant for this stock is an aggressive, nearly desperate strategic pivot into the defense and security sector. The market's expectation for Nuburu before this recent surge was simply one of a struggling microcap with a promising yet commercially challenging industrial laser technology, facing continuous financial strain and the real threat of delisting. However, the reality that the market is currently digesting, and what's driving this volatility, is a massive, sudden transformation into a defense tech systems integrator through a series of planned acquisitions and joint ventures, the most recent being a key strategic framework agreement to establish a joint venture with Maddox Defense Incorporated for advanced drone systems, specifically targeting the NATO market. This news, which estimates a potential $100 million in annual revenue by the end of 2028 for the joint venture, is what has fundamentally changed the narrative and forced this substantial price movement. The expectation was the slow bleed of a failing tech startup. The reality is a high-risk, high-reward bet on government contracts and military defense tech. The stock's immediate movement is all about this pivot. Looking closer at the last few trading sessions, the volume has absolutely exploded. The reported daily volume is in the tens of millions, a massive spike for a stock that had a market capitalization in the low tens of millions just before this news. This signals a frenzy, a clear indication that a large number of retail traders and likely some opportunistic institutional funds are piling into the story, anticipating what's essentially a short squeeze or a further re-rating of the company based on a new, much larger addressable market. The typical Nuburu investor was, until very recently, one who might be tracking niche industrial laser advancements, but today the holders are chasing the defense angle. The trading action has been highly volatile, with the price swinging wildly from a low of around $0.29 to a high of $0.4205 intraday. The recent institutional activity, even before this latest drone news, hinted at the underlying shift with certain small institutions like Vanguard Extended Market Index Fund and Fidelity Extended Market Index Fund holding positions. These positions, while small in the context of their overall holdings, represent exposure to a highly illiquid and volatile microcap, suggesting a passive play on the eventual re-rating or a potential for outsized short-term gains, which is common in stocks with a high short interest percentage, which Nuburu has historically possessed, hovering around the high teens percentage of the float. For anyone thinking about engaging with stocks like this, it's a totally different ballgame than allocating capital through a passive instrument like Schwab Intelligent Portfolios or building a long-term position in something stable like Apple stock or a growth name like Nvidia stock through a conventional individual brokerage account with a firm like Fidelity or Interactive Brokers. This is a purely speculative, news-driven trade, heavily dependent on the execution of an unproven strategic shift. The common understanding, the general belief about Nuburu, was that it was a distressed asset. Their original core business was the development and manufacturing of high-power blue laser technology for industrial applications, primarily welding and 3D printing of materials like copper, gold, and aluminum. The physics is compelling. Blue lasers are absorbed much more effectively by these highly reflective materials compared to traditional infrared lasers, promising faster, higher quality, and defect-free welds. This technology is genuinely cutting edge, but the reality of their financial situation was dire. They reported minimal revenue in the low thousands against massive quarterly losses in the multi-millions. Their balance sheet showed negative shareholder equity and a high debt-to-equity ratio, painting a clear picture of a company whose commercialization efforts in the industrial space were failing to generate the necessary cash flow to sustain operations. This financial instability forced them into multiple dilutive equity offerings, with one recent offering raising about $12 million, but dramatically increasing the share count, which is a significant headwind for the stock price. This is where the contrarian take comes in. The market is now saying, forget the blue laser welding business. The deep-seated market belief that this company was simply a slow-motion bankruptcy is being aggressively challenged by the idea that they can outsource or license the blue laser tech while using a new defense subsidiary, Nuburu Defense LLC, as an acquisition vehicle to quickly assemble a revenue-generating portfolio in a government-subsidized, high-margin sector like defense tech and critical infrastructure resilience. This is a dramatic and high-stakes gamble by management. The daily swings illustrate the tension between this historical financial reality and the new defense sector expectation. The stock price acts like a highly sensitive barometer for every piece of news related to this new strategy. For instance, the stock surged in the weeks leading up to this latest drone announcement after they disclosed a plan to acquire a controlling interest in an Italian defense tech company, Tecne Spa, which supposedly has a large order backlog tied to NATO contracts. Similarly, the news that the NYSEAMERICAN accepted their compliance plan, addressing previous delisting concerns, provided a temporary boost, removing one of the immediate existential risks. However, even during this upward trend, the stock remains incredibly volatile, evidenced by a recent drop after the company received a warning letter from the NYSEAMERICAN for a technical disclosure violation, not providing advance notification for a press release. These wild price movements make it clear that the stock is currently trading on narrative and speculation, not on solid, consistent, or even current financial performance. The fact that the stock is experiencing high volatility with a high average true range, or ATR, suggests it is a playground for short-term traders and those engaged in high-risk self-investing strategies, potentially utilizing aggressive margin accounts on platforms like Robinhood, or taking advantage of low-fee active trading on SoFi Invest. This is not the type of security you'd find comfortable holding in a diversified, intelligent portfolio set up for a decade of growth. The original blue laser technology, while currently overshadowed, remains the company's core innovation. The company's unique value proposition is the ability to produce high-brightness, high-power blue lasers, which are superior for processing materials like copper due to their specific wavelength. This is a legitimate technology in the field of additive manufacturing and advanced industrial welding. Their business model was straightforward: sell the laser systems, Nuburu AO150 and BL250, to industrial clients for manufacturing and metal processing. The challenge was commercial traction and scalability. The transition costs, R&D expenses, and the relatively slow adoption cycle in heavy industrial sectors simply outpaced their ability to generate sufficient sales, leading to the financial deterioration reflected in their older reports. For example, the 2023 financial outlook projected total revenue greater than $3 million, but EBITDA in the range of -$21 million to -$23 million. Clearly showing the burn rate was unsustainable without significant capital injection or a dramatic shift in strategy. The $12 million capital raise and the establishment of Nuburu Defense LLC earlier this year weren't just a pivot. They were a corporate Hail Mary to survive and find a faster path to large contracts and, crucially, to revenue. Shifting focus to the future, the entire investment thesis for Nuburu stock now hinges on two words: execution and integration. The market's expectation is that the management team, led by Executive Chairman Alessandro Zamboni, can successfully transform this struggling laser company into a functioning, profitable defense and security hub. The reality check is the sheer difficulty of this transformation. The catalysts are clear: the formal closing of the Techne and Orbit acquisitions, the definitive agreement with Maddox Defense to formalize the drone joint venture, and, most importantly, the announcement of real, substantial contract awards, especially from NATO or U.S. government agencies, that translate to actual, recognized revenue. The management has guided for billings of approximately $500,000 in the current quarter from the defense side, which is a small but symbolic starting point. If they can start reporting multi-million-dollar contracts, or if the projected cumulative revenue of $165 million by 2028 from the drone joint venture appears credible, the stock will likely experience further explosive moves upward. However, the risks are immense, and they directly contrast with the